door for the next two bullish hurdles at $1.29 to $1.36. Far stretch away, possible nonetheless. I'm sure we'll have an update before those come into fruition. All right, let's get down to business. We're going to start off today with doing our weekly outlook. As you all know, these things tend to be very accurate as I try to pay attention to the utmost detail that we all need to be mindful of in terms of data, scheduled headlines, and things that could unfold in the coming days ahead that will keep us aligned with institutional order flow and the market dynamics as we head into a new business month. So, of course, starting off with Monday, Tuesday, Monday's relatively light on the calendar day. We don't really have any scheduled data, but then Tuesday through Thursday, we have an absolute data tsunami with labor market data in focus. Of course, we have geopolitical confrontations to digest that took place over the weekend. And then we also have a holiday this Friday rolling into the weekend with the July 4th celebration via the United States. So, lots to unpack today. We're going to get into the total cryptocurrency market cap, XRP, XLM, take a look at dark pools, just of course doing the first start of the month kind of overview. Take a look at some levels. We'll also take a look at some if-then scenarios and some levels to be mindful of on MNQ and just set the tone and the pace as we roll into this new month. I want to show you guys something that I'm paying very close attention to in terms of things that I'm reading and how history has unfolded in the past surrounding some of the data releases that we're going to get and how it could play out with the potential sentiment moving forward. So you all will see that as well in today's breakdown. We'll take a look at that and kind of where I went on the economic calendar to find that information so you can kind of see how I'm piecing and putting that together. All right. David had a community-led Zoom call this rising. They recorded that, so if you missed it, it was good. Camille did a good breakdown on delta helds and whatnot, and going over the dark pools and kind of what to see from the higher time frame down to the lower time frame. So I'll make sure to update you all and upload that in the monthly roundtable Zoom section in the coming days ahead, just whenever David has the time to email me that recording. All right. So let's get started. This is going to be the weekly outlook so far. Of course, I'm going to check this out to you guys before the market opens for Asia session. So just be mindful of any adjustments that may need to be made headed into tomorrow's New York session for any overnight announcements. Starting off here, before we get into the technical analysis outlook, as we head into the first week of July, traders should be prepared for one of the most important macro weeks of the year. Although it will be shortened trading week due to the Independence Day holiday, that does not mean that volatility will be lower. In fact, the opposite is likely. With the U.S. market closing early for the holiday and non-farm payrolls being moved forward to Thursday, because of course it usually tends to unfold the first Friday of every single month, but now because of the holiday, it's being moved up to Thursday. The market has less time to digest an enormous amount of economic data. On top of that, we are entering a month end, quarter end, and a half-year institutional rebalancing, where large funds are repositioning portfolios and liquidity can become, of course, extremely thin. Thin liquidity combined with high-impact economic releases and geopolitical uncertainty often creates sharp price swings across both traditional and crypto markets. For us, in this community, there are going to be two major themes that we're going to be paying attention to that will likely dictate market direction this week. And that is number one, of course, the Middle East developments, and number two, the U.S. economic labor data and the changing Federal Reserve expectations. Now, over the weekend, tensions between the United States and Iran escalated once again. President Trump announced that U.S. aircraft struck multiple Iranian military targets, infrastructure, air defense systems, surveillance assets, and mine laying capabilities. According to military reports, at least 10 military targets were destroyed following Iranian attacks on commercial shipping in the Strait of Hormuz. President Trump warned that Iran had violated the ceasefire agreement and suggested that continued aggression could force, I repeat, could force the United States to finish the military job. Iran quickly responded. Iran's Revolutionary Guard claimed responsibility for the retaliatory strikes targeting U.S. military facilities in Kuwait and Bahrain, stating they had destroyed several strategic bases. However, U.S. officials reported no American casualties and no significant operational damage. Bahrain confirmed only limited structural damage to a residential building near its international airport, while Kuwait intercepted two incoming ballistic missiles without injuries or damage. So perhaps the most important takeaway here is what did not happen. Despite all of the military headlines this weekend, we know that commercial shipping through the Strait of Hormuz still continues uninterrupted, at least for now. That tells us that these developments remain largely contained as military signaling rather than a complete breakdown of the ongoing negotiations. Excuse me. This is where it starts to get important. Okay. Because right now, what are we seeing? If you go over to crypto Twitter right now, all these news platforms are like making all these breaking headlines, making you feel like the fear is going to continue. And that might not be the case. So we need to start to pay attention to detail here. Markets appear to agree with what I'm saying for now. Crypto over the past 48 hours has barely reacted, continuing to hover around the $2.05 trillion market capitalization level, despite numerous military headlines. As you can see in the screenshot here, we are still consolidating around 2.05 trillion. If price remains below this level, further downside, of course, is warranted. Ideally, we would like to see buyers turn this level into support and defend it passively, trapping sellers and becoming aggressive above 2.05 trillion if we want to see a sustainable bullish recovery. So right now, this is the most recent screenshot of the total cryptocurrency market cap. You can see that as we rolled into the weekend from Friday, we are currently just consolidating. We're literally operating in this range right now where price is kind of gripping towards the dark pool at the 2.05 trillion threshold. So even though there's been major geopolitical escalations over the weekend and major announcements, it doesn't really look like crypto's reacting that drastically. Now, of course, the environment is still risk off, prices are still pressured, and we're still seeing net outflows across the board on major layer ones that are all still down significantly this year. So I'm not ixnaying the risk off environment, but it does seem as though the market isn't pricing in the headlines as aggressively as the headlines are making it seem right now. So we need to look into that a little bit deeper, right? So what does that mean, for, at least from my perspective? At this stage, it seems like the market appears to be viewing these developments as threats. I highlighted that in bold, rather than confirmation of a wider conflict. That can change quickly. However, meaning traders should remain extremely alert to any headlines involving the Strait of Hormuz, oil infrastructure, shipping disruptions, or indications that peace negotiations have, in fact, completely collapsed. So I'm just highlighting some of the rhetoric from some reports that I was reading this rising to write this report for you all, and you can see that here. It says, there may come a point where we are no longer able to be reasonable. That doesn't mean that right now they are, i.e. them being the United States. It says they may. So this seems like a threat to me. And then here also the same vocabulary says, if that happens, the Islamic Republic of Iran will no longer exist. So again, it's an if that happens scenario. If further confrontation unfolds, then we could see further attacks. And right now, we're not as of right now, right? So that's why I think that the market has had a muted reaction to the breaking headlines this weekend, because albeit it does seem like from a headline perspective, things are escalating, the market might not perceive it to be such a huge deal if things don't continue to escalate further, right? It says here also, you can see the word threats. So Saturday night's threats against Iran, and if they continue with tit for tat attacks. So again, that rhetoric that's kind of like teeter-tottering between continued military escalation or possible de-escalation, depending on the next 48 to 72 hours worth of announcements that come out in the coming days ahead. Right. So I'm always just trying to lock you guys in and understand that the narrative that's being painted to average retail investors always isn't what's behind the curtain. And if you actually peel apart the vocabulary, it's throwing out in the scenarios if then headlines. Right. So that's what we need to be mindful of. In regards to the data tsunami, and in regards to the data tsunami ahead, while geopolitics remain important, macroeconomic data may ultimately determine where markets trend throughout July. This is where it's going to get important, and I want to take you back significantly enough. I don't think it's a coincidence. We're entering into the same time horizon where the markets were back in July, August of 2024, and we're also starting to teeter-totter around the same fundamental environment. Now, if you guys were in this community in 2024, when I go over this breakdown, you're going to be like, wow, I can see it, because I remember being on Zoom calls in 2024 and you saying the same exact thing that I'm about to say to you guys now. So watch when we get to this part. So The Federal Reserve currently, of course, faces an increasingly difficult balancing act. Inflation has remained stubbornly elevated, while recent economic reports have shown the U.S. economy continues displaying surprising resilience. Rising oil prices during the Iran conflict, stronger GDP revisions, continued AI-driven investments, and persistent inflation have all contributed to markets dramatically increasing expectations that the Fed could raise interest rates later this year. Right now, according to the CME Fed Watch tool, the market assigns roughly a 77% probability that the Fed raises rates before year end. So, what do you think this week we're going to be paying attention to? Let's highlight that in bold. Does this percentage inch closer towards 100, or do we see data that comes out that takes this percentage chance back towards 50 or below 50% odds of a rate hike? That expectation has been one of the primary reasons why crypto and other risk assets have struggled throughout recent weeks. So, this week's data will directly challenge or reinforce that narrative. The economic calendar that everyone will be watching. The biggest event arrives Thursday with the June non-farm payrolls report. Right now, the expectations are plus about 114,000 jobs, that the unemployment rate remains relatively steady at 4.3%, which is the previous reading, and average hourly earnings comes out plus 0.3% month over month. Now, of course, before Thursday, we also have ADP private payrolls, JOLTS, challenger job cuts, ISM manufacturing PMI, factory orders, the S&P case shiller, and Conference Board consumer confidence figures that we will also all break down on Zoom call throughout the week. Every one of these reports, of course, will feed directly into how investors view the Federal Reserve's next move. So, why this week's labor market data matters so much? Let's break that down in detail. The labor market represents one half of the Federal Reserve's due mandate alongside inflation. Inflation, we know, has already remained higher than policymakers would like. Now, markets need to determine whether employment is finally beginning to soften or continues to remain resilient. So, if the labor market remains extremely strong while inflation stays elevated, the Federal Reserve has very little reason to ease monetary policy. That would not be good for risk assets. However, if employment begins showing signs of slowing, while inflation also starts easing in the coming weeks ahead, then the conversation could change very quickly back towards eventual rate cuts. That is a shift in expectations that we as risk asset investors would love to see. That would support crypto and tech stocks. So, in this report that I was reading from, I think it was Yahoo Finance copied a index report from Bloomberg or something like that. And it says here from this one analyst, as for the labor market, Hollenhorst sees payrolls losing momentum this summer, starting with the upcoming June jobs report. Weekly jobless claims have been trending higher too. It will likely take the unemployment rate rising for the market to go back to pricing in rate cuts, but soft payrolls and unchanged unemployment should at least push the markets to price out rate hikes. So, what I want to show you guys real quick is this if then bullish scenario based off of some historical data. So, I said here to you all, if this week's labor data, specifically Thursday's employment report, comes in weaker than expected with payroll growth missing estimates, job openings continues to decline, and unemployment holding steady on increasing slightly, markets could begin removing expectations for future Federal Reserve rate hikes. This would likely pare back some of the recent US dollar gains, reduce treasury yields, and improve overall risk appetite in the coming weeks ahead. And it would create a more supportive environment for NASDAQ and crypto as we head into July. In the moment, we need to be careful, however, because bad labor market data prints can add what? What do we know about the past that bad labor market data reports can add in terms of the intraday sentiment? Can somebody tell me?
Recession fears.
Recession fears. Good job, Graham. So we know that recession fears tend to do what? In the moment, for that intraday price action or that week that recession fears surface until the market gets confirmation that the Fed's willing to ease, then we know that risk assets can also sometimes underperform in that environment. So I said here, we need to be careful because a bad labor market print can add recessionary risks, and the initial reaction to recession fears is a risk-off environment until markets start pricing in rate cuts, right? And a perfect example of this is August to September 2024. So I want to take you guys back. And like I said, I don't think that all of this is coincidence. So, for example, here in this economic report from Bloomberg, from a Bloomberg analyst, or whoever this person is, I don't remember who this Holland Horse person is. They're from like a hedge fund or an institution, but they're projecting that labor market data is actually going to come out showing signs of weakness. And let's go back to the charts. All right. So, we're going to go back to 2024, August to September timeframe, and I want you guys to pay attention to these two historical moments in history. Now, if we look down at the bottom of the charts, you guys know that I'm a very big like advocate for time. Time increments and the way that things happen in terms of time are so important. So this area of price action right here was August 2nd. It was a Friday, the first Friday of August. So what did we get that day? The first Friday of every single month, what data report do we get?
CPI?
Nope. First Friday of every month, what data report do we get?
NFP?
NFP, right? We get labor market data, just like what we're about to get this Thursday. It was supposed to happen on Friday, but this Friday is a holiday. So we're getting it on Thursday. But the first Friday of every single month, we get the non-farm payroll report and the unemployment claims. The unemployment rate. So this was Friday, August 2nd. And what happened, right? If we go and we look at the economic calendar, anybody can do this. You come to the economic calendar, you click this week's current non-farm employment change, but you can go back and you can look at the historical reports. So let's go back to August 2nd, 2024, and it takes us over here. And here is the list of all of the fundamentals that came out that day. And if we click on this, what does it say? It says, U.S. economic update, labor market aggressively weakens to its weakest point, excuse me, and the market starts pricing in the probability of a Fed easing cycle of up to about 50 points. But it says right here, it says the rise in unemployment rates accelerate. And now we expect the market to start easing in September. It says it right here. So remember, look at the date. This is now August, and the market's expecting this to happen in September. So in the moment, this horrible labor market misprint, it did what? It caused recessionary fears. And if you look at how the market reacted, even though the market starting to price in rate cuts is bullish for risk assets, look at the reaction. The market still dropped because in the moment, fear was still embedded into the market. So the markets dropped. Then in September, what did we get? We come and we fast forward here, right? So here is another Friday. This candlestick right here is Friday, September 6th. So what did we get? We got another labor market report. And if we come over to the calendar, we come up here to September 6th, 2024. Look at the data. The previous reading was 89,000. The market was expecting an upbeat reading of 164,000, and we still had a misprint to the downside of 142,000. So the market actual came out below the forecast, which shows what? Weakening or cooling labor market data. And so if we click on that report and we go look at the economic reports from that day, here is here is September 6th, 2024. And look at what it says here. Here's a report that came out that day. August's unemployment report, which was weaker than markets were expecting, but stronger than our call, cements our view that the Fed's easing cycle will start at the next Federal Open Market Committee meeting, September 17th through September 18th. So then if we go back and we look at the charts, here you can see the bad reaction from the recession fears, and here you can see the negative reaction from the next unemployment report, where the market then starts pricing in aggressive easing. And look at what happens. Fucking boom. That's when the bull run started, or the bottom happened after August, September, where we went on this huge rally all the way up into the all-time high in crypto. And now, think about it where we're at. The market's all fearful that the Fed's going to hike rates, and look at what's happened. They've priced that in. Everybody's de-risked. Well, now, what if in the next couple of economic reports, we actually see that the economy still needs stimulus, it still needs support, it still needs easing. And so let's say this week, or maybe at the next labor market report, we see weak data, which causes the recessionary fear narrative. And what does that allow the market to do? sell off one last time, which then in the following months, the market will start pricing in aggressive easing. So we'll get a sell off. Wouldn't be surprised if we come and we liquidate that area back from August that I mentioned underneath of these lows where over leveraged positions sit before this huge rally that took shape. And then we start to see a bottom in crypto. We're seeing the same exact setup right now that we saw in 2024. The fear narrative take over, but in reality, once easing is confirmed and the market starts pricing that in again, this thing is going to absolutely start to tear, right? So that's why I'm saying in the moment, even if the data comes out supporting rate cuts, i.e., a weaker or cooler labor market figure than what the market's currently pricing in, we can't just jump into aggressive buying opportunities right away like Twitter and YouTube influencers are going to make it out to be. They're going to be, oh, rate cuts are here, right? Be careful because remember, the immediate reaction to bad data can be that recession narrative. And we know based off of historical context that recessionary fears cause risk off environments, right? So until the risk off environment ceases and we get confirmation from more data that the Fed is going to start to cut, which would be cooler inflation and more weak data as we head into July, then we can start to really position ourselves, especially if those lower level dark pools start to come into fruition. So I just wanted to show you guys some of that chess that I'm playing with the market and just kind of showing you all where we're sitting at in the landscape and what's coming out in the days ahead and why it's so important to pay attention to that. Now, to continue, a softer labor market doesn't automatically, like I said, mean immediate rate cuts, but it would represent one of the first meaningful steps towards markets abandoning their increasingly hawkish expectations. Of course, we have to play the bear scenario as well. If payroll growth significantly beats expectations while wage growth accelerates and unemployment remains low, investors would likely conclude that the economy remains too strong for the Fed to ease monetary policy. That would likely reinforce expectations for additional rate hikes later this year. Higher yields, a stronger US dollar, and tighter financial conditions would likely pressure risk assets once again, potentially extending recent weakness across both crypto and equities. Now, on the flip side, we could see an environment where the market's already priced in resilient US labor market and rate hikes. So even under those conditions where we see things remain strong and elevated, it might not have a negative effect because the markets might have already pre-priced that in. Now, in regards to NASDAQ, we also know that a stronger economy and stronger data from the United States sometimes also can benefit stocks. So just be mindful of those scenarios as well. We're definitely going to have to play a couple of good detailistic scenarios when the fundamentals come out this week and really dive into the weeds of it. So my job will be very important breaking this down for you guys this week on when this data comes out. As we continue, not everyone agrees on where monetary policy is headed. Many institutions, including Bank of America, now expect the Fed to raise rates multiple times before year end. Their reasoning centers around persistent inflation, resilient economic growth, elevated oil prices, and Kevin Warsh's notably hawkish comments during his first press conference as Fed chair, which I personally think was a systematic plan to crash the markets before the institutions come in so they can buy at a discount and shake out all the retail leverage before they pump this thing to Valhalla. That's my personal opinion. Warsh emphasized that restoring price stability remains the Fed's highest priority and suggests inflation remains unacceptably high. However, several respected economists remain on the opposite side. City Chief's U.S. economist Andrew Hollenhorst, so that's where this dude came from, argues that markets have become far too aggressive in pricing in future rate hikes. He points out that oil prices have already fallen substantially from their conflict highs, consumer spending has quietly weakened, housings continue slowing, and weakless jobless claims have gradually increased. His view is that labor market weakness will come increasingly apparent during the summer and eventually forcing markets to remove expectations for additional rate hikes and begin pricing in future rate cuts instead. And when I read that from a city economist, I literally was like, ha, this is the 2024 playbook to the frickin' pip. This is literally exactly what they did in 2024. We had the yen carry trade unwind. We had the data that came out that dropped the market down into a discount from where they bought from before. Then we had September bad data, and then the market started pricing and easing, and we went to the freaking moon. And so, what are we seeing again? Yen carry trade intervention headlines, right? I know that you guys have seen them. I've seen them over the past consecutive couple of days, and I've been sending to you all in the Discord. Yen carry trade interventions, freaking labor market data. Everybody's fearful right now, and where we're at. We know we're in dark pool area right now for buy territory. We know we're at a discount. We know that crypto's not going away. It makes so much sense for them to play this playbook again like they are right now, right? So let's wrap this up and finish this up. Final thoughts. This week has the potential to set the tone for the entire month of July. We have a rare combination of geopolitical uncertainty, quarter end institutional positioning, reduced holiday liquidity, and one of the most important employment reports of the year, all occurring within just 4 trading days. For now, crypto continues holding above the critical $2.5 trillion region. Sorry, this is supposed to say at. Despite the military escalation over the weekend, that resilience is encouraging, but it does not guarantee strength if economic data surprises to the upside and reinforces the Federal Reserve's hawkish outlook. Our primary focus should remain on 2 things this week. First, monitoring every significant headline coming from the Middle East, particularly anything involving the Strait of Hormuz, oil infrastructure, or peace negotiations. Second, we're going to watch how markets react to the labor market data rather than simply the headline numbers themselves. Sometimes the market's interpretation matters far more than the report itself. If employment begins showing a meaningful sign of slowing, investors could rapidly unwind expectations for future rate hikes. That would likely create a much more favorable backdrop for Nasdaq and crypto as we move deeper into July. The next 4 trading days could determine whether risk assets begin building a sustainable recovery or whether higher for longer interest rate expectations continue to dominate market sentiment. So, with that in mind, right now, on the total cryptocurrency market cap, very plain and simple. We're not going to spend too much time on this. A sustainable break and hold above 2.05 trillion would then open up the door for us to overcome this seller that's likely to passively defend it where they trapped buyers halfway in between the dark pool between 2.05 and 2.03 trillion, which puts us at about 2.2 trillion as our first bullish hurdle. So if we can see buyers sustainably hold 2.5 trillion, trap sellers, then we can start to make our way up into this trapped buyer at 2.2 trillion, where we're likely to see some resistance, or the seller that passively trapped this buyer here throw up some defense. If we can see buyers overpower that seller that's resting and sitting there, then we can make a case for a recovery from this last and most recent sell-off to head back towards 2.3 trillion as our first bullish target. Of course, any sustainable break above 2.3 trillion opens the door for our next AOI, which will come in at where this trap buyer sits at about 2.5 trillion. Anything above that opens the door for 2.6, but that's kind of a far stretch away. I don't think that that's going to happen in 1 week. So we'll stop there. We could see another week of consolidation where we don't get that, and instead we just get a stagnant scenario where we just consolidate for the next couple of days at 2.5 trillion, which wouldn't be a super positive scenario, but also wouldn't be super negative either. Last scenario, of course, would be risk off. That means we do not see a sustainable break above this most recent trap buyer or the seller throwing up a passive defense. It starts to act as a resistance. We break back below 2.5 trillion. That would open up the door for a nice drop down into 1.8 as our first bearish target underneath 2.05. If we don't see a formal attempt by buyers at the beginning of the week to break up into higher territory, then we could just remain below 2.5 trillion, and that would be the worst case scenario and would open up the door for a significant drop down into 1.8 to 1.71 trillion. XRP and XLM real fast. So first, having a look at XRP. Right now, things are not looking too good. I mentioned to you all that we need to see a sustainable break and hold above that $0.07943 threshold. You all can now see, remember we had the Zoom call, was it yesterday or the day before, on XRP, breaking that down for you all. In that Zoom call, I said, there's all these bullish moon boys out there that are giving these price predictions, but here we are in this community, and we know that on the lower time frame, we had a beautiful rejection of the 1.07943 dark pool to the absolute T after sellers passively defended it here in this area, trapping buyers, breaking previous support, retesting it and becoming aggressive, we now have seen buyers make an attempt to retest and reclaim 107,943, and we can see that the seller here still exists and has passively defended this area successfully. That means the scenario that we discussed in that Zoom call, what was it, a day or two ago, now comes into fruition. Now the question is do these buyers that were able to defend and absorb some of the sell volume here in this area continue to do so? If they cannot, and the buyer stop losses underneath of these lows get ran, we're likely going to see that buy squeeze down into 91 cents. So for the bullish scenario, under optimistic conditions this week and favorable environments for risk assets, we could see the buyers here defend at these levels, trap sellers, become aggressive, and of course that first hurdle is going to be the $1.07 threshold. If we can break above that sustainably and turn it into support, in my personal opinion, we're not going to stop there. The next hurdle is going to be $1.18. That would be bullish scenario number one. Of course, if we fall under the consolidation scenario, then we could just see range bound price action in between this base and maybe $1.11. In an extreme bullish environment, of course, any sustainable break above $1.18, and that opens the door for the next two bullish hurdles at $1.29 to $1.36. Far stretch away, possible nonetheless. I'm sure we'll have an update before those come into fruition. These right now are the only two bullish scenarios that I'd be looking for if buyers can maintain and hold the support at about $1.01. So to me right now, what this is looking like is this bullish move that we just witnessed over the weekend was simply just sellers taking profit from previous week's sell-off. And because the sellers were able to passively defend to this $1.07 threshold, if these sellers start to become aggressive beneath these lows, get ready because it's not going to be pretty. All right. So that leads us into the bearish scenarios. If we cannot sustainably break above the $1.07 threshold, mind you, right now we are on the hourly. Let's go up to the 4-hour. So we cannot see buyers start to step in and defend these lows and push price back above $1.07. That is going to open up the door for the first bearish scenario, which is a retest of $1.07 or this trap buyer and a break beneath the low. And that's going to open up the door for a nice squeeze down into the next dark pool area or the delta area that comes in between the $1.07 and 91 cents and put us into this territory, which is, of course, lower than what we're trading at today. If we don't see a nice rise in an attempt by buyers to defend this low and push back above $1.07, then the last bearish scenario would just be a nice smooth drop underneath of this low, retesting the previous support that then acts as a resistance, and that would also open up the door for a lower XRP price. So right now that $1.07 threshold in this most recent base is our last line in the sand. If we can break above the $1.07 and turn it into support, then we can ixnay these bearish scenarios. As for XLM, the last update that we gave was a beautiful call out. If you guys remember, if you see now, I haven't changed any of my drawlings. I mentioned that if we want to see any higher prices on XLM, that we needed to break this weekly high. We failed to do so. You can see that buyers got trapped. And I mentioned to you all that if we were unable to sustainably break above the weekly high from a previous week, that we were likely going to see a retest of the 1423 psychological level or the dark pool that comes in on the May 23rd date, 4 days before the announcement of the DTCC. So remember, the DTCC announcement was Wednesday, May 27th, and everybody thought that that was what pumped XLM's price. But in reality, you can see that 4 days before that, on May 23rd, we had a beautiful buy delta held pattern at the dark pool 423. And I mentioned that we're likely to see the strength of those buyers tested. And so now we're coming into that territory where all these aggressive buyers are about to be tested by sellers. So we're likely to see the test of strength by buyers here where they could defend. There was clearly aggressive buying here, these large bullish candlesticks, which is where we're currently operating in. And then I'd say that the last test of strength for buyers is going to come in at the dark pool at the 1423. So for a bullish scenario, if we can see the buyers defend, and interestingly enough, also remember that test from the DTCC is coming in the month of July. Now, I think that if I'm not mistaken, it's only Canton that's being tested, but I don't think that things are coincidence or happen by accident. So if we do start to see the buyers defend at these previous levels, then that could result in a nice bullish move up into the dark pool at the 34.3. All right. So be prepared for that in case we do see the buyers defend. If we cannot see the 14.23 defended and we start to see all these buyers losing to sellers and sellers just aggressively surpassing that buy volume, then that is, of course, going to open up the door for our first bearish target at the 14.23. If we break below the 14.23, that's probably going to result in all hell breaking loose. And the next bearish target for XLM buys would come in at the 0.872 dark pool. So XRP and XLM levels updated just to show you guys some levels to the upside on XLM. We have some higher level sell dark pools at around 30 to 49 cents, just in case.